When it comes to retirement, every dollar counts, and understanding how to make the most of your Social Security benefits can have a significant impact on your financial well-being. In this video, we'll walk you through 4 simple steps you can take to increase your Social Security benefits and set yourself up for a more comfortable retirement. Before we dive into the 4 easy ways to increase your Social Security benefits, it's crucial to understand the basics of how Social Security works. First, we'll cover how Social Security is funded, the role of payroll taxes and FICA, and the key factors that go into calculating your benefits. Social Security is a federal program that provides retirement income, disability income, and survivor benefits to eligible individuals. But how is it funded? Social Security is primarily funded through payroll taxes, which are levied on both employees and employers. This tax is part of what's called the Federal Insurance Contributions Act. When you look at your pay stub, you'll notice deductions for federal taxes and possibly state taxes. In addition to these, there's also a deduction for FICA taxes. These taxes are split into 2 parts, Social Security and Medicare. The Social Security portion is 6.2% of your income, up to a maximum limit that changes annually. For 2023, the cap is set at $160,200. Your employer also contributes an equal 6.2% of your income, up to the same cap, making a total of 12.4% going towards Social Security. Now that we know how Social Security is funded, let's take a look at how your benefits are calculated. Social Security benefits are calculated based on your lifetime earnings, with a specific focus on your 35 highest earning years. This approach ensures that your benefit is more reflective of your overall career earnings rather than just a snapshot of your most recent income. In order to account for changes in wages and the cost of living over time, your past earnings are adjusted for inflation. This process, called wage indexing, ensures that your benefits are accurately based on your real lifetime earnings. For example, in 1993, the maximum earnings subject to Social Security tax were $57,600, whereas in 2023, that cap has increased to $160,200 due to inflation and wage growth. Once your 35 highest earning years have been identified and adjusted for inflation, Social Security calculates your benefits using a method called means testing. The goal of means testing is to ensure that lower-income earners receive a larger percentage of their pre-retirement income than higher-income earners. Here's how it works. Your average indexed monthly earnings are calculated based on your 35 highest earning years. Then the average indexed monthly earnings is broken down into 3 income brackets, with each bracket being subject to a different benefit calculation rate. For 2023, the brackets and corresponding rates are as follows. 1. The first $1,115 of average indexed monthly earnings is replaced at a 90% rate. 2. Any amount between $1,115 and $6,721 is replaced at a 32% rate. 3. Any amount above $6,721 is replaced at a 15% rate. To illustrate this, let's consider 2 individuals. Person A has an average indexed monthly earnings of $160,200, while Person B has an average indexed monthly earnings of $80,100, exactly half of Person A's amount. Due to means testing, Person B's Social Security benefit will be more than half of Person A's benefit, even though their earnings were only half as much. Let's now delve into the concept of full retirement age and its implications for your Social Security benefits. We will also discuss the impact of early collection and delayed retirement credits on your retirement income. Understanding these aspects is crucial to making informed decisions about when to claim your benefits. Full retirement age is the age at which you become eligible to receive 100% of your Social Security benefit, based on your lifetime earnings. The full retirement age varies depending on your birth year. For those born in 1960 or later, the full retirement age is 67. For those born between 1938 and 1959, the full retirement age gradually increases from 65 to 67. And for those born in 1937 or earlier, the full retirement age is 65. The Social Security Administration allows you to start collecting benefits as early as age 62. However, claiming benefits before your full retirement age results in a permanently reduced monthly benefit. This reduction is determined by the number of months between your early collection and your full retirement age. For each month you claim early, your benefit is reduced by a certain percentage, which accumulates to a significant reduction if you claim several years before your full retirement age. On the other hand, if you choose to delay claiming your Social Security benefits past your full retirement age, you will earn delayed retirement credits. These credits increase your benefit by a certain percentage for each month you delay, up to age 70. This increase can result in a substantially higher monthly benefit, potentially providing you with greater financial security during your retirement years. Deciding when to claim your Social Security benefits is a personal decision that depends on various factors, such as your health, life expectancy, and financial situation. By understanding the implications of full retirement age, early collection, and delayed retirement credits, you can make a well-informed choice that best suits your needs. If you anticipate a longer life expectancy and can afford to wait, delaying your benefits may provide you with higher monthly payments in the long run. Conversely, if you need the income earlier or have concerns about your health, claiming benefits early might be the right choice for you. Now that you know all of this, let's now start with the 4 ways to increase your Social Security benefit. 1. Work a full 35 years. Your Social Security benefit is based on your highest 35 years of earnings. If you have fewer than 35 years of earnings, the missing years will be factored in as zeros, reducing your average earnings and thus your benefit. To maximize your benefit, try to work a full 35 years, ensuring that all of your highest earning years are included in the calculation. If you are nearing retirement and have already worked 35 years, consider whether your current earnings are higher than your lowest earning years. If so, continuing to work could replace those lower earning years in the calculation and increase your benefit. To wait longer to collect, as mentioned earlier, waiting to collect your Social Security benefits can significantly increase your monthly payment. If you can afford to wait, delaying your benefits until after your full retirement age will earn you delayed retirement credits. These credits increase your benefit by a certain percentage for each month you delay, up to age 70. This strategy can provide you with a higher monthly income during your retirement years, especially if you expect a longer life expectancy. 3. Understand spousal benefits. If you are married, understanding how spousal benefits work can help you maximize your Social Security income. Spousal benefits allow you to collect a benefit based on your spouse's work history, even if you have little or no work history of your own. You can receive up to 50% of your spouse's full retirement benefit if you claim at your full retirement age. Both spouses can't collect their full benefit and spousal benefits simultaneously. However, by coordinating your claiming strategies, you can maximize your combined benefits. For example, the lower-earning spouse might claim their benefit early, while the higher-earning spouse delays their benefit to maximize their monthly payment. 4. Understand survivor benefits. Finally, understanding survivor benefits can help you secure a higher income for the surviving spouse in the event of one spouse's death. Survivor benefits allow the surviving spouse to collect the deceased spouse's benefit if it is higher than their own. To maximize survivor benefits, the higher-earning spouse should delay their benefit to increase their monthly payment, which will also increase the potential survivor benefit. By implementing these 4 strategies, you can significantly increase your Social Security benefit and secure a more comfortable retirement. Remember to consider your unique circumstances, such as your health, life expectancy, and financial needs, when determining the best approach for you. Consulting with a financial advisor or using online resources and calculators can further help you assess your options and make the best decision for your retirement. Next, we'll discuss additional ways to prepare for a financially secure retirement beyond Social Security. To make the most of your retirement income, it's crucial to understand the impact that Social Security has on taxes, retirement income, and investments, as well as making smart withdrawal decisions from your portfolio. Social Security benefits may be subject to taxes, depending on your overall income. To minimize the taxes on your benefits, consider coordinating your Social Security income with other sources of retirement income, such as pensions, annuities, and investments. By carefully timing the withdrawals from these sources, you can manage your taxable income and reduce the taxes owed on your Social Security benefits. Additionally, it's important to understand how your Social Security benefit will affect your overall retirement income. Your benefit may be a significant source of income, but it likely won't cover all of your expenses. To maintain your desired lifestyle in retirement, you'll need to supplement your Social Security income with other sources, such as savings, investments, and part-time work. Assess your projected retirement expenses and create a comprehensive financial plan to ensure you have enough income to meet your needs. Social Security benefits also have an impact on your withdrawal decisions from investments. Making smart withdrawal decisions from your investment portfolio is essential for maximizing your retirement income. The order in which you withdraw from different accounts, such as traditional IRAs, Roth IRAs, and taxable accounts, can have a significant impact on your taxes and the longevity of your savings. One common strategy is to withdraw from taxable accounts first, followed by tax-deferred accounts like traditional IRAs and 401, and finally from tax-free accounts like Roth IRAs. This approach allows your tax-advantaged accounts to continue growing tax-free or tax-deferred for as long as possible. However, this may not always be the best strategy for everyone, as your individual circumstances and financial goals will dictate the most appropriate withdrawal order. When deciding when to claim Social Security, consider the impact it will have on your withdrawal strategy. If you can afford to delay claiming your benefits, you may need to withdraw more from your investment portfolio initially, but doing so may result in higher Social Security benefits later, potentially providing more financial security in the long run. Coordinating Social Security with other financial decisions is critical for making the most of your retirement income. By understanding the impact of Social Security on taxes, retirement income, and investments, and making informed withdrawal decisions from your portfolio, you can create a well-rounded financial plan that supports your desired lifestyle in retirement. Consult with a financial advisor for personalized advice on coordinating your Social Security benefits with your overall financial strategy. Thank you for joining us in this video series on increasing your Social Security benefit. We hope you found the information valuable and wish you the best in your retirement planning journey. If you liked the video, please subscribe to the Finance Bowl for more money and investing tips. Until next time.